By now, you've heard that there is no one-size-fits-all approach to investing. In fact, there are many different types of strategies you can consider applying based on a number of factors, like how much time you want to spend on your investing strategy and how much financial risk you're willing and able to take on. Let's go over a few basic investing strategies. First, the growth strategy. Growth strategy investors are mainly focused on capital appreciation, which is the rise in value of their investments. An investor who uses this strategy creates a portfolio with the majority invested in stocks from growth companies. These are companies that appear to show a potential for high growth and earnings. They can vary in size, but most often, these are smaller companies that are focused on expanding. Growth companies often do not pay dividends because they would rather reinvest earnings back into the company to drive up further investment and growth. Once a growth company becomes more mature, they may start paying dividends to investors. These companies tend to have a relatively high stock price when compared to their financial information, such as book value or earnings. This is because the market is expecting their earnings to grow quite a bit in the future. Because of this, investors are willing to pay a higher price now for any expected future earnings. We often see growth stocks in the news, like technology stocks. Investors should be aware that growth stocks tend to fluctuate in price and carry relatively more risk than other stocks. Second, the value strategy. Value strategy investors search for stocks that they believe are underpriced in the market when compared to the company's financial information. For example, there could be negative sentiment in the news that can drive a stock price down for the short term. This reduction may lead some investors to think that the stock price is not reflective of its balance sheet and earnings potential. Fun fact, one of the world's most well-known investors who applies this strategy is Warren Buffett. Value strategy investors generally have a tendency to buy and hold investments for longer periods of time. So rather than sell investments relatively quickly, like within a few months of purchasing, for example, they might keep their holdings for a while. They do this expecting to see significant long-term returns. Next, we come to the third basic investment strategy, income. An income strategy investor's main goal is to not only see portfolio growth, but to collect regular income in the form of interest payments, dividends, and distributions as well. When managing their portfolios, they might try to strike a balance between investments that will earn them income and also expose them to a relatively lower level of risk and volatility. Companies that income investors seek out tend to have lower price volatility and stable earnings growth. Many of these companies would be considered mature or established, and significant growth would generally not be expected. Examples of companies that fit this profile are utility companies. Let's look at dollar cost averaging now. Dollar cost averaging is another strategy that can help provide a disciplined approach to investing and reduce the urge to invest based off our emotions. An example of dollar cost averaging is investing a fixed amount of money into a product, like a mutual fund, every single month. Let's say each month we invest $300 into a mutual fund. In this example, if the mutual fund lowers in price, then the $300 can be used to purchase even more units than before. And if the price goes up, then less units can be purchased. The goal of this strategy is to lower the average price paid for investments by spreading purchases over a broad period of time, rather than timing a purchase to try and buy at a low price point. Let's now look at investing strategies related to how engaged or active an investor will be with their portfolio. Passive investing strategy aims to maximize returns while keeping trades to a minimum. It's generally considered a set and forget strategy for long-term investors who don't want to commit a lot of time to managing their portfolio or researching their next investment. Usually, these investors aren't looking to time the market and they're not looking for quick gains. Instead, they might be attracted to ETFs and mutual funds that align with their objectives and provide options to diversify their portfolio to reduce overall risk. Index investing is the most common form of passive investing, and it aims to track the performance of an index, like the TSX 60, Dow Jones Industrial Average, or the S&P 500. Index investors might be satisfied with market returns by investing in ETFs and mutual funds that track a selected index, and they aren't generally looking to take on additional risk to try and outperform the market. Alternatively, an active investing strategy is used by investors who want to try and outperform the market. They might try to do this by trading more actively in individual securities, or by holding ETFs and mutual funds that strive to achieve higher returns by the fund managers. Because they are more actively managed, they tend to have both relatively higher fees and risk associated with them. While there are dozens of investing strategies that you can learn about, we've covered some of the most common ones in this lesson. When an investor is trying to determine which strategy they want to apply, it can sometimes seem overwhelming. Some strategies are more sophisticated, while others take a more straightforward approach. As a new investor, you may want to consider starting off with easier strategies and work your way up. But ultimately, the choice is yours. Figuring out which strategy you are most comfortable with takes time and practice. So remember to enjoy the journey.